Hello and welcome to the Investment Coffee Break. Now today we're going to be discussing gilts or government bonds. And these have not really been of significant interest for several years. But now with the changing economic landscape, there's renewed appeal. To explain why, I'm joined by Dave Thomas, one of our investment managers at our London head office. Dave, can we start off with just asking the question, what exactly is a gilt?
Hi Andy and hi everyone. What is a gilt? Very good question. Well, quite simply, gilts are secure savings vehicles which are issued by the Bank of England on behalf of Her Majesty's government and are listed on the London Stock Exchange. When they were first issued, the certificates were printed on paper with a gilt edge, and this is why or how they got their name. And the first issue dated back to 1694, when King William III needed £1.2 million to stage, to get the money together for the war against France. So a gilt is effectively a loan to the government, and they pay out a regular income known as a coupon. Most government bonds are issued at a price of £100, and the coupon is set at a fixed percentage of the issue price. When the gilt reaches the end of its term, the full £100 value of the bond is repaid.
Excellent. Okay, so what's changed then to make them more appealing?
Absolutely. I think on the next slide, we'll start to look at why gilts are looking attractive. But before we do this, I think it's important to understand, firstly, the relationship between bond prices and yields. So bond prices and yields are inversely related. So that means when a bond price falls, the yield rises and vice versa. As a result, bond prices are particularly impacted by changes in interest rates. So in a rising interest rate environment, bond prices will tend to decline. And this is because the rate of return on a newly issued bond will be higher than on old bonds that were issued when interest rates were low. So the only way for those old bonds to remain competitive is to lower their price so that their yields increase. So now that we understand this dynamic, we can now look to understand why they look attractive, and we can see that on the chart here. So on this chart, we've got different colours. These colours reflect the UK, the US, and the German developed government bonds. The orange one in particular is our UK gilt. But what we can see here is there is clearly a correlated theme, and we can see they have now hit the highest levels of yield offering over the last 10 years, which you can see here. The reason for this is because interest rates have been going up very, very quickly over the last 18 months in particular, and this is in an attempt to combat inflation. And therefore, bond yields have had to rise in order to remain competitive to levels we have not seen for over a decade. And this is the first important positive that should be highlighted. At this juncture, it is important to consider what might happen if interest rates were to go up further, because clearly if that were to happen, that means potentially bond prices could go down. And so on the next slide, we've got a relationship between bond prices and yields. And we can see here, this one I've entitled Bond Pricing and Bond Convexity. And this shows us how the relationship works. And what you might be surprised to see is how this is not a linear relationship, and one that I mean that is a straight line, but actually one that is convex or curved. And what you can notice is that as interest rates and thus yields rise, the impact to bonds, the bond price, which is the y-axis, the impact on those bonds to the downside becomes less and less, as can be seen on the chart here. So clearly, if interest rates were to go up further from position Y1 on the x-axis, then the impact to price is less than it would be at Y2, which would have been the case when interest rates were lower. And this is very much reflective of where we've sort of been over the last 18 months. So therefore, this is really the second positive point we're trying to get across here now. And what we can say here safely is that should interest rates and thus bond yields rise any further, then the negative impact on bond prices becomes less and less. And after 13 interest rate rises in a row in the UK, we are now at a position where we can lock in those yields which you saw on the previous slides, which is at the highest point it's been for over a decade, and where any further downside should be pretty much miserly. So I think that's the second important point to mention. And the very final point, if I can get that one in as well, is to mention that, on this slide, when interest rates eventually turn the other way to appease an eventual slowdown or recession, which effectively means riding back up this yield curve the other way, which in turn means bond prices appreciating. So that's the third point I'd like to raise. So I think given everything we've explained, holistically, I think bond yields are looking incredibly attractive, not just in isolation, but as part of a wider strategy that offers ballast and protection to the rest of one's portfolio construction. So we should now explain that gilts have differing coupons. We have a high coupon, which is where we have a higher interest associated with it, where most of its value is associated with this interest. But we also have a low coupon version, which pays a very small level of interest, but instead this low coupon bond trades at a deep discount, rendering most of its capital profit at maturity, which is when the bond is redeemed.
Okay, excellent. That's really interesting. Thanks, Dave. So what's the tax treatment of bonds if people were to invest in them?
Yeah, so the very unique, and certainly for the time being, the tax treatment on and the unique property of a gilt is that the capital profit is completely free of tax. And this is going to be particularly the case with low coupon gilts, where we know most of its embedded value is within that capital uplift to £100, which is what I referred to earlier. And this is making them even more attractive given the current deposit rates at the bank. And what we can see on this slide here is sort of how we might utilize some of these low coupon bonds and the tax advantages later. But in the meantime, you can see on this gilt list in the columns you can see here is the redemption yield, the gross redemption yield on the one in the red box you can see there. So that is the 31st of January 2025 gilt that had a coupon of 0.25%. So clearly a very, very small coupon. But this particular gilt is trading at 92.45, which you can see in the asking price column there. So what this effectively means is you can see one column more to the right-hand side. The gross redemption yield on that particular gilt is 5.32%, which is clearly much more, or quite a bit more, than deposit rates that you can get at one's at respective banking institutions. So what we've done on the other three columns on the right-hand side is we can see what sort of rates at one's respective marginal tax rate would a bank have to offer for them to outperform these particular gilts. And you can see there for this January 2025 gilt, if we have an additional tax rate payer, a deposit rate at the bank would need to be 9.46% for this gilt not to outperform. And I think this is where we sort of particularly now start to see the advantages of these low coupon gilts within taxable portfolios. So clearly there is an advantage for holding these gilts within taxable portfolios, given not only for the additional yield, but the tax breaks involved. Furthermore, with capital gains tax allowances halving this year to £6,000 and then going to £3,000 next year, only reinforces this strategy, which can be seen in practice on the following slide. So you can see on the previous slide that there were lots of different gilts, and what we've sort of shown here is it is our job to blend lots of these different gilts within different investment vehicles, such as taxable accounts, which is the client GIA, that stands for General Investment Account, and client SIP, which is a self-invested personal pension. But you can see within those sort of tables, beneath those titles, we have different types of bonds, which is our efforts to try and create the most tax-efficient vehicle, given those respective investment vehicles. So for a client GIA, for example, we've already mentioned that the CGT allowances are halving this year and then halving again next year. So clearly there is a strong motivation to try and incorporate these low coupon gilts where most of the embedded value is within that capital gain uplift, where they are capital gains tax free. And that is why you can see under the client GIA, you can see they are predominantly consisted and comprised of low coupon gilts. Conversely, within client SIPs and ISAs for that matter, the motivation is not as great. And so we can use sort of higher coupon bonds within these investment vehicles.
Thanks for that, Dave. Can we just have a quick summary as to what the attraction is then?
Yes, absolutely. I appreciate there's quite a lot of slides here and quite a bit of content, but I think hopefully a few key points have come out. And I think that one of the most important ones is that bond yields across the board are the sort of highest they've been for over 10 years now. And their prices have certainly suffered most of their damage in that time, as interest rates have risen 13 times in a row, to a point where their price falls now should be much, much smaller, if at all. Furthermore, with recessionary pressures mounting, we know this interest rate cycle will need to turn to appease that dynamic, which does add another element to their appeal. Certainly when you start to think about creating ballast and protection as part of the wider investment construction. Low coupon gilts have most of their value embedded within the capital return to £100, and given dwindling CGT allowances, this certainly allows for more tax-efficient planning versus cash alternatives, which is accentuated even more so within taxable portfolios.
Excellent. Thanks, Dave. We do know, of course, that there's a risk with every investment, and really the risk here is that there's the government could default or not repay these gilts or these loans. How many times has that happened in the history of gilts?
Again, quite uniquely, I suppose. I know lots of other economies there have been defaults, but certainly from the UK's perspective, there hasn't been one since 1697, I believe, which is when they started.
Brilliant. Good to know that. Thanks, Dave. And thank you for joining us. We hope you found that useful and look forward to you joining us again next time.